So hello, welcome back to a new video. This is a topic today which I wanted to cover for quite some time, and I really thought about how to tackle it because it describes one of the biggest problems many traders have, and it's basically that the whole approach, how they approach their trading from a technical perspective when they talk about technical analysis, and also what traders believe technical analysis is often very flawed and very wrong, which then leads to, of course, wrong assumptions, a wrong approach, and then bad inconsistent trading. And also the traders don't really understand what is going wrong, why are they failing. They think they are on the right path, they think they're doing the same thing like everybody else is doing, it should be okay, but it's not going anywhere, and many traders struggle. So I really want to cover the topic today: what is technical analysis really, and what does it mean, and how you should approach technical analysis from a different and probably better perspective. So the most traders, they are always only acting on the surface level when it comes to technical analysis. They are just looking for the quick get rich quick thing, the thing that looks easy, that seems to be so easy to implement, it makes sense. You just throw on an indicator or two, or you follow one or two patterns, and then you hope that everything works out, because just looking at a few historic charts, you can see that sometimes the pattern works well, you don't see really when it doesn't work well, and you cannot really understand the implications of that. So trading is more, and it cannot be reduced to just trading a crossover. You cannot just trade based on indicators when they show overbought, oversold, or divergences. And backing up a little bit, there is even no such thing as overbought or oversold. Those are terms which have been used in trading, but they're completely wrong. I just challenge you, when you're using a stochastic, for example, or any other indicator, just look at the formula and you will understand no such thing as overbought or oversold exists. It is completely wrong. It is a myth. I don't know why it is established for so long. Traders don't really understand it, and it just shows that many people have a wrong understanding. They just try to make it too easy. They try to look for the quick thing. Just like when it comes to dieting or getting in shape, everybody likes the 5-minute app, or the electric shock therapy, where you just put some stickers on your stomach and then next day you wake up with a six-pack. Obviously, that's not how it works, and it's the same thinking that applies, or many people try to apply to trading. Technical analysis and trading cannot be reduced to such a surface level. Financial markets are complex things. Millions and millions of traders, financial institutions, governments interact on a daily basis on your charts, on your price charts. They drive the price discovery. So just looking at a moving average crossover, or looking at pin bars and hoping that just trading pin bars will make you rich is just not going to cut it. We must look deeper. We must really understand what is the chart telling us. We must understand that the price moves because the buyers and the sellers, they interact on our charts, depending on who's in control, who is stronger. Are the buyers stronger? Are the sellers stronger? What are the signals that they are giving us? What are the charts telling us? And looking very deep, not just at, is this a pin bar? Is this a crossover? Is the 12 period moving average better? Should I use a 13 or maybe an 11? That's not really helpful, but we must look deep at the charts. We must understand how to read momentum from our charts. We must understand to read the buyer and the seller balance. And there are very specific clues, as we will see shortly. And the market is following this universal and timeless rhythm and the patterns. And this is something that it's not that complicated, but many traders, are not even aware of it. And most books or sites, they never talk about it, because of course it sounds easier if you just tell another trader, just use the 14 period moving average and then look for a cross, and then everything will be all right. But that's just not how it works, and I really want to get this point across today. Also, market selection is a very important skill. You cannot trade all the markets all the time. The traders, just because you call yourself a trader, does not mean that you have to trade all the time. Knowing when not to trade is maybe even more important than knowing when to trade. And this is also something that we need to learn when it comes to market selection, and that's also something we will explore. So in my trading and what I've come to learn over the past years, I've been trading Forex for over 10 years, is that it does not matter which market you follow. I trade Forex mostly, so sometimes commodities, but mostly Forex. But it does not matter. You can pull up any chart, any time frame, any period, and you will see that the market follows the same rhythm. The same building blocks is what all the markets are made up of. It does not matter what chart you pull up, whether you use here the live cattle futures from 1980, I think a daily chart, or you look at the Polish zloty 1999. You can see that it looks quite similar. There are certain things that look similar, that stand out, and those are universal and timeless chart reading principles and charting principles, which I want to introduce to you a little bit and help you understand really that we need to look deeper and what deep technical analysis really means. So let's back up a little bit, and I will give you a quick introduction if this sounds too basic. And if you are tempted to click the X button on your browser, don't do that, because there's something interesting waiting for us. So whenever we look at a chart can only do one of three things. It can go up, it can go down, and it can go sideways. Not that new of a discovery, I hope. But it's very important to understand this implication. Furthermore, if you look at chart rhythm and chart phases, there are just certain periods and certain things that the market can do. So there are bottoms or consolidations where the market goes sideways. We have breakouts when the price leaves such a consolidation. Those breakouts can be during the trend or at the beginning of a trend. We have pullbacks after the breakouts. We have early trends after the pullback is confirmed. Then during a trending phase, we have consolidations. We have periods where the price is stalling. Then the trends go on and we enter a mature trend stadium. When the mature trend ends, we have a market top, and when the top reverses, we have obviously a reversal. And then everything starts over. Of course, this is not how the charting will work all the time. The sequence may change, the strength of the individual periods may change, but basically those are the 6 or 7 phases that any chart can be made up of. There's nothing much else, and we need to understand that those are the only things that can happen on our charts. Of course, important to understand the phases can change, and also the strengths and how strong those things manifest on your charts will always change. But that is where the deep technical analysis comes in. So whether we look at breakouts, at ranges, consolidation, trends, pullbacks, the building blocks of all those phases are what we call waves. Very important. Those things have nothing to do with Elliott waves or Wolf waves or any of those wave theories. It is just the term that we use to describe when the market is going up, we have a bullish wave. When the market is going down, we have a bearish wave. And that is the general terminology that we use. Very important to understand in this context is that we need to be able to understand that the length and the steepness of those waves can tell us a lot about the trend strength and who is in control. Is the market going up very strongly, like here with those strong trend waves? It means that we have a lot of buyers. Do we see small consolidations during such a period? Like here or here, it means that the sellers are not really interested in the market and they are not really interested in driving the price down. So it is likely that we are seeing a continuation and so on and so forth. So trend strength and the waves in general tell us a lot. And they are the building blocks of all chart patterns, chart formations, as we will see. So let's quickly take a look at dissecting waves and how we can use those waves to understand momentum. So for example, we have here or had a very strong uptrend here, very strong and a very steep price wave to the upside, shows the buyer surplus here very nicely. And then the next trend wave is a little bit shorter. It is still bullish, obviously. And then here the next trend wave is even shorter. So it already shows us here, just looking at this very, very basic and very early technical analysis concepts, that just by looking at that, we can already assume, or we can understand that the bullish participants are leaving here a little bit. They are not as strong anymore. The sellers are more and more interested in building an opposition and helping the price or stopping the price from moving higher. And you can see here afterwards, the price just faded sideways. Another example, you can see we are starting with a very strong downtrend, and then you can see on each push to the downside, the trend waves were less and less steep. You can also see that the corrective waves, as we would call them, the waves in the opposite direction to the ongoing trend, they're becoming deeper and deeper and longer. And then here at the bottom, you can see the price is almost not able to break the low, so it's more or less a double bottom here. And then afterwards, you can see we are starting the uptrend, when you also can see that we are breaking the highs and then changing the trend sequence. So again, this is very basic, but you can already see that when we approach technical analysis from such a more general idea or perspective, where we really try to understand the buyer and the seller dynamic, what are the waves telling us, then we can already see a much better way of approaching technical analysis, I hope. So let's just take a look at a few selected chart patterns, and we can see that those are made up of waves as well. And if we understand how to read those waves, we can improve our chart reading abilities a lot. So head and shoulders is one of my favorite patterns, and you can see we're coming here from an uptrend. The price is making higher highs and higher lows. The bullish waves are much stronger, but then here you can already see from the left shoulder to the head, the market is already showing a little bit of weakness. It's not able to push as easily as high as you can see here previously. Then the right shoulder here, it already shows us that now the market is not even able to push back into the highs, which means that the buyers are not really as interested in the price action anymore. The sellers are much stronger. You can also see that the previous bearish trend wave here is much stronger than what we have seen here previously during any of those market waves. So this is two very important clues. Then here we can see that the market is breaking the neckline. We have a super strong seller influence and seller influx. And then you can see here we are starting the new trend to the downside, as now clearly after the head and the right shoulder, the markets are breaking the lows as well. And now the bears are in complete control. The bears and the bearish trend waves are much longer. And this is here we don't even need to call it head and shoulders, whatever it is. And it also helps us to move away a little bit from this template thinking where you just, many traders, they learn it very early on, is where they just hunt for very specific things. They have their textbooks and then they wonder, is this a head and shoulders? Is this not a head and shoulders? And trading does not really work that way. If you are just relying on textbook patterns, you will very quickly realize that very rarely do you actually have textbook patterns, because the price and the market is very dynamic. Volatility plays a big role. And if you're just looking for textbook patterns, you quickly realize that one, those patterns rarely exist. And second, if you have a variation, then you're not really sure about it and you don't know how to trade it. So understanding the markets from a more general perspective, looking at wave analysis, is a very, very big help. Trend lines as well, one of the examples from my own trading, we have a trend line. The market is going up, higher highs and higher lows. Never ever during this period had we ever broken this sequence, higher highs and higher lows all the way. The only break here then existed where this exists. We first broke the trend line, where we then also confirmed now we are making a more bearish trend wave. Look at just this trend wave, just compared to what has happened here previously. Never have we ever seen such a strong bearish trend wave. We're breaking the lows, which means the trend structure is changing. General Dow theory, if you know a little bit about it, says that a trend is confirmed as long as we make higher highs and higher lows, or on the opposite side, lower lows and lower highs. Here on the left side, we have higher highs and higher lows all the way. Just look at the trend structure. You never have a violation of this rule. And then here suddenly we break it, we make a lower low here. The price here previously was also not able to make a higher high, so we make a lower high as well. And this is all just based on wave analysis and looking a little bit deeper. And you can see, just move away a little bit from this surface level thinking of just looking at crossovers, divergences only. This will make a very, very big impact in your trading. Wedges are also a very good example, because they can tell us a lot if we know what to look for. So wedge is characterized by, or triangle, whatever you want to call that. We have here two trend lines, an upper one and a lower one, and we can already see, just looking at the angle, what do we see? The lower trend line here is moving higher much faster, which means that the lows are pushing higher and higher and higher much faster than how the lows are coming down, the highs are coming down. So it means that every time the price tries to make or moves here lower, first of all, the buyers come in earlier, and the sellers are not able to push price as low. Every time the buyers are interested earlier and earlier, and then the final signal is given here. When we break the sequence, we make a higher high now in this case as well, and then we start this trend wave. So just look at how the highs and the lows are forming, what are the buyer and seller waves doing, and then you can already read the market sentiment. Triangles, essentially the same. We're coming here. It can also be something like head and shoulders. From here to here, we barely break the previous lows. We just barely make a new low here. Then on the right side of the triangle, we can see we make a higher low, and at the same time, the price is always pushing in the same support, in the same resistance. This is a flat top triangle, and then we break it. We make a higher low here as well, and then you can see what happens afterwards. So you can see already the buyers are coming in earlier and earlier. The sellers are not able to push price lower and lower. And yeah, that's also here how you can use this principle. So even though you maybe know now how to read price analysis and waves, and it is important to understand that this is not enough now, but it is a good starting point to analyze market structure, buyer and seller dynamics, and go a little bit deeper. You still have to build confluence on top of that. So in my own trading, I use a mix of different patterns. I trade 3 different patterns with different criteria. I use Trendlines. I also use Bollinger Bands for my reversal trading. And those are all the things that you can layer on top of it to build a strong approach. But I just wanted to highlight the importance that looking at a crossover or just looking at like overbought and oversold is just not enough. You really have to understand what the markets are telling you, and that is what I want to highlight here. If you're interested in learning how to trade like me and with me, if you want to learn my system, there's a link below this video where you can get a step-by-step approach. We do it everything slowly, market analysis, momentum analysis, wave analysis. You get an introduction to all of my 3 patterns step by step. And then as well in our private member forum every week, I give you a complete breakdown of the Forex and the futures markets, where I analyze the current market conditions, situations, what I'm looking for, what is the market telling us, and how do we position ourselves. But the next step is, as I said in the beginning, being neutral as a position. So many people make the mistake, they always think that they have to be in a trade. They always look at the markets from, is this a buy or is this a sell? They don't really recognize that there's something in the middle, and it is maybe one of the most important positions. So being flat, being neutral, and not taking a trade is very important. And market selection is where this comes in. So in the previous section, I also only showed you very nice charts, and those nice charts are only what I trade, and those things are based on market selection. So I trade around 35 Forex pairs, 10 futures, so 45 markets across 2 or 3 time frames. So this gives me already 100 combinations, but every week I only end up with around 3 to 6 trades on average, which means that I can be very, very selective. Out of those 135 possible opportunities, time frames, and market combinations, I only get a handful of trades the most, because I filter out everything that does not look nice. So if I see that the market is not giving me any clues about technicals, if I cannot read wave analysis, if I cannot apply my knowledge about wave structure, if the trends are not nice, then I will sort out such a market. And I only look at markets where you have clear swings, the trends are very, very well established, you can find very clear patterns, and those are the good technicals, and this is what I call a bad markets. And so market selection helps you understand, and it also, first of all, when we back up, it also forces you to really understand your system. Because when I ask a trader, what is your system? And then he answers with I trade moving average crossovers, then it's just not enough. Because you have to back up, and as Moritz said in another video, your methodology has to make sense. And in order for it to make sense, you have to really understand it. So for example, when I talk about my trading, when a trader asks me, what do you do? And then I say I trade momentum and I look at buyer-seller balance. Then I know also what I'm looking for. I know that I need a market where you have clear trend waves, where the volatility is moderate, where you have clear structures as well, clear patterns. And those are the good markets, and that is a good sign that I know my system. On the other hand, I know also what a bad market is, what I don't like to trade. And most traders, they don't really have that to begin with. They don't really understand what their market is telling you, what their system is based on. So this is a good opportunity to just ask yourself, do you really understand your system? Do you know the principles? And do you know the criteria? And write those down, create a checklist, and then it helps you also to really make sense of what you are actually doing as a trader, rather than just hunting a moving average crossover, which doesn't really make any sense, because what is it telling you? Look at what the moving average crossover is really telling you and what it means in the broader market perspective. If you're losing money right now and if you're struggling, then I am very, very sure that it is not because you're using a wrong indicator setting or you are using a wrong indicator, but the most likely reason is that, first of all, you don't understand really what you're doing, and second of all, you're probably managing your trades not in a good way. When I look at a trader and when I look at his trading approach, when I look at his performance, even though he's taking good trade entries, whatever this means, what happens afterwards is not really guaranteeing or making sure that he's able to see the success. So cutting winners early is a very big problem. When you're in a trade, you always get scared out early. Very, very big problem. Even then, it does not matter how good your technical analysis is and how good your entries are. If you're always cutting your winners too short and you let your losers get out of hand because of emotional problems, then this is also guaranteeing you that you are going to lose money. So you really need to work on this aspect of trading as well. And good technical analysis can help you understand your charts. It can help you understand, are you in a market where your position is working right now? Are you in a market where the buyer and the seller balance is supporting your trading idea? Or are you in a market where it is shifting, where it is not as clear? And if you really know how to read the trend waves, and you're able to read the momentum and what is going on right now, then you can trade with more confidence. You are able to understand who is in control. Is this in line with my trading idea? And then you can let your winning trades run. You can get out of losing trades early on. And that is a very, very big difference. And when I look at a trader, or when I talk about trading, I always see that what separates the good from the bad trader is not only how he determines his trade entries, but it often has to do with how he approaches his trading overall, and especially what happens after his entries. So even though the trader might have the best entries, if he's completely mismanaging his trades, then this is also making sure that he's never going to see any progress. So I really hope this helps you understand what the point of this video is. Technical analysis is more than just the surface level. You really have to go deep, understand what the market is driving, who's in control, buyers versus sellers, momentum analysis, wave analysis, really dissecting it, really looking deep, and then layering other things on top of it to really get a good system out of it with good confluence, and also something that makes sense for you, because you can only trade your system with confidence if you really understand actually what you're doing, and if the thing that you are using and the analysis approach that you're using actually makes sense to you. So if you like this, make sure to give me a thumbs up, leave a comment below, and then I will see you in the next video.